May 2023, builders' confidence increases substantially. As builders start to realize that there's not enough inventory in the market, the National Association of Realtors states that most people that are buying right now are buying new homes in excess of 33% of the inventory, which is substantial because the average new home resale compared to the entire market from 2000 to 2021 typically averages 12.5% of all homes being sold. But over the last 4 months, we have seen that home sales in excess of 33% have been new home, new construction. Well, one of the big contributors is the fact that there's a lack of inventory. And because most home buyers that are already in homes, they are afraid of spending more money on interest. They have stabilized fixed rates, 30-year fixed mortgages, 15-year fixed mortgages. They'd rather stay put, stay in their homes, remodel, renovate, and do home improvement than go out and buy a new home. And so because of that, there is less inventory of pre-existing homes in the market, hence making it extremely attractive for buyers to seek and search for new homes that are new construction. So builders' confidence month over month from February to March, March to April, April to May, and as we move into June, builders' confidence continues every month to get stronger and stronger and stronger. Now, one of the big things is that construction material costs have softened a little bit, but there is still inventory crisis on some key components like electrical transformer. Some electrical components are probably the two largest items right now that builders are being faced with pushback on. I know for me personally, I got an apartment complex that's under construction and another one that's nearing construction, and it's the panels that you put the actual meters in that we can't get anywhere. We're buying them and sourcing them all over the country and even out of the country, and it's about a 15-month lag time on these large commercial developments that we're doing. And so on a single-family residential standpoint, there's still a need and there's still a pushback. And so there are still components to the availability of inventory and what's available as far as supply and supply chain right now, even in May of 2023. But in spite of that, builders are still building. In fact, what's been really cool is I was just reading an article from the National Association of Home Builders. And one of the things that the National Association of Home Builders was talking about, which I love about the National Association of Home Builders, because they give real data, real stats, and they give real components to the market that most people are trying to seek off of Fox News, NBC, CBS, ABC, and all the news networks that are all driven based on reviews, and we're looking at real data. And so when we look at the National Association of Home Builders and their standpoint on stuff, it's all real tangible data that fuels the market economically. And so one of the big things that they were talking about is they were talking about where buyers' confidences were and where builders that are building like big program communities are, and as far as what they're offering to the end sellers. And so where in February of 2023, over 64% of home builders were offering some type of buyer's incentive to get into their home. Now, in May of 2023, less than 51% of builders are offering an incentive for buyers to move into their home, which means that buyers' incentives have softened and been reduced by over 18% just in the last 3 months. And so every month, month over month, the number of buyers, of builders gives to the end buyer have changed. And so one of the big things is we want to make sure that people understand, because what we educate people on, what we've been advocating for, and what I tell people in the 2008 recession is that there's a demographic marker in building homes that people continue to buy. Now, it just so happens that across the board, from affordable housing, median housing, and upper middle class housing, even the ultra wealthy has been changing. I read an article last week, and it was talking about, and it was actually our mainstream news media that came out on ABC. It was the local news media that said that there was a need for the ultra wealthy and homes in excess of $2.1 million. So for the first time in history that I've been a builder in excess of 25 years, it's the first time ever that I've seen that there's a shortage of homes for the ultra wealthy. So if we're talking about the first demographic that gets hit the hardest, which is the median home buyer, because those are the people that are affected by any type of volatility in the market. Because if their income changes by even $500 a month, it can put them in a state of bankruptcy or the loss of foreclosure on their home if it happens for a consecutive 60 days, 2 months. That constitutes for over 74% of home buyers. What's the second market that gets hit? The ultra wealthy. Because those are secondary homes. Those are a lot of times vacation homes. They're homes that people don't necessarily need, want, or have to have. And so the second market that gets hit is the ultra wealthy. Homes in excess of $1 million. Now, we look at the demographics that we market to, and I tell people, if those two market sectors are improving, which they are right now, based on everything that the National Association of Realtors is giving us, and the National Association of Home Builders is giving affirmation to the National Association of Realtors. And so if both of those entities are giving affirmation, the number one strongest market for home buying is the upper middle class, which constitutes for 24% of home buyers, which still constitutes for millions of people across the United States. Now, one of the big things I want people to understand is that as this market shifts and changes, what does this mean for financing? We know that banking, interest rates, and all of what's happening in the banking sector right now, there's a lot of instability in the market. So I'll tell you that cash purchases are up by 14%, meaning that those people who have affluency are buying cash because money is a lot more expensive today. But hence, not everybody can go out and pay cash for a home. So now let's look at the majority, okay? And let's talk about people that are building homes. Now, banking is changing, and because there's so much distress in the market right now, and because money is so expensive, the ability for home builders to borrow against money from the banks, they have to be able to have a profitability standpoint that can afford the debt as they build that asset. And with banks increasing interest rates month over month, and the Federal Reserve going in and doing these quarter point basis hikes, which I think we still have 2 more over the next few months that we're going to see. How does that affect the actual developer, the end builder? And yes, the answer is it does affect them. We're in the multifamily ground up development, ladies and gentlemen, and I'll tell you guys that everybody's pushing us towards HUD lending right now, because HUD lending is just over market value of money. Market value of money right now is at 4.85%. But we can get a HUD loan at 5.1%, where if you go to market with traditional conventional lending, you're sitting closer to about 7% right now. Now, under the construction loan sector, we're going to be looking at closer to about 8.5% to 10% as far as construction loans, almost double the 5.1% that we can get if we utilize HUD. Now, for single family home builders, one of the big things, if they're doing this broad, if they're doing like a massive development where they're doing 100 homes, 200 homes, and they're going after lending, they can also do HUD lending. But I'll tell you guys that conventional lending is still more desirable than even HUD. And here's why. Because HUD lending right now is being advised that investors go in and utilize, but it takes 10 months on average to get HUD approved. And in 10 months from now, if we think about it, we're in May. So we got May, June, July, August, September, October, November, December, January, February, March. We're at the end of the first quarter of next year before we can even get that loan out of the ground. So one of the big things right now for a lot of investors that are borrowing money is to be able to have a bandwidth that you have to wait all the way till March right now is not as desirable as being able, because the market's going to change. So if we wait for lending all the way till March and you hover from now to March, there's so much that can happen in 10 months. There's so much money that can be made, so much money that can be lost, so many opportunities that can be passed upon on to be able to be held out for 10 months. So what I've been telling people, as I said, you could utilize HUD as a worst case scenario. Like if lending doesn't improve, if interest rates are still high, and if the most desirable type of lending for developers, investors is HUD lending, but between now and March, then you execute. But if not, start looking at other third-party ways of getting financing. Now, I'll tell you guys, 2008, hands down, and it wasn't 2008, it was 2010, 2 years after, where we were getting hard-pressed by financial institutions. It was credit unions that actually saved us. And it was credit unions because they are non-for-profit, meaning that they're not going in and they're not ran by a CEO that has a profit or an ulterior motive and an incentivized. They are ran by its members. They are owned by its members. And so credit unions typically don't spend as frugalously, and they typically have the bandwidth for better lending in times of financial distress because their bottom line and their books are typically substantially more healthy than the average median or regional or community bank. And so understand that right now your bandwidth for relationships and lending is extremely, extremely important. So as the residential market improves and there's more opportunity within the single family home sector for buying land, building houses, and generating profits from it, one of the areas that's getting hit the hardest right now is commercial real estate. And I'm talking commercial real estate across the board. It doesn't matter if it's office and retail being the two most financially distressed asset classes in the commercial space. But then right behind it comes warehouse, multifamily, storage, land, all of that stuff. And the biggest reason why, you say, well, I thought there was a need for housing, Jerome. How can multifamily be getting hit so hard? Well, I'll tell you guys, because right now, most people will leverage these properties expecting to be able to exit their properties in 2 years, 3 years, 4 years. They syndicate as general partners, and then they make their internal rate of return when they sell. Well, if the market is too volatile and money gets expensive and they become vulnerable to their 5-1 arm, which means that they have 5 years fixed, and then at the end of 5 years, they have an adjustable rate mortgage. That's what an ARM stands for. Then what ends up happening is they have so much volatility in their interest rate, the cost of money that they utilize to go out and leverage that asset goes up so substantially that now they don't know how to make the payments because the cap rate, the cash on cash return, doesn't service the mortgage amount itself, putting it in a state of financial distress. So ladies and gentlemen, as residential single family home starts to improve, we got about a 2-year window before we even see the beginning of the commercial real estate improvement on every level, from retail and office to multifamily, industrial, warehouse, doesn't matter, across the board. When banks are tight with their money, lending less, and values have dropped so aggressively, you're going to feel it as an investor in the actual standpoint of the market of investing, because money is not as liquid as it once was just a year or 2 years ago. And so, ladies and gentlemen, the means of everything that we're talking about promoting here is to focus on getting active income through the means of single family ground up construction, because it's almost recession proof at this point in time in relation to what the market is highly in need of, and yet it is still extremely, extremely lucrative as far as your profits. And as far as the multifamily space, that is one of the areas you want to pay attention to as far as being able to pick up financially distressed assets. Because as Class A, Class B, and Class C product comes to the market and banks are forcing these investors to sell that were on 5-1 arms and paying out dividends on their returns, they're going to have to sell this at a loss. Hence, short sales on commercial real estate is an important place for your mind, your efforts, and your underwriting to stay for the next 2 years, because there will be opportunity in the commercial investment sector. Ladies and gentlemen, if you like this content, you want more content just like this, pound that thumbs up button, give us some love, and then click and subscribe to our YouTube channel so that you're notified when we have more market updates or just regular real estate information for you to benefit from. And always remember, ladies and gentlemen, go out and compound your success.